All right, guys. I'm going to start talking about chapter 11 today. More than likely, I'll keep it a little bit short. It's about management of bond portfolios. There are essentially two types of bond management. One is passive management. The other is active. I'm going to talk about passive management today. And on Thursday, we'll talk about active management of bond portfolios. Let me put this up. Of course, we won't have any Jeopardy this week, but starting after spring break, we're going to go into our regular schedule. You guys will have your quizzes and stuff before you come back, and we'll go from there. Assuming I don't have a setback. I don't want to. I want to finish this semester. So if I'm going to take time off, if I can't take time off, it'll be starting in the fall. All right. Pen decides not to write. Bonds are not something that you carry in isolation. If you're an individual, maybe you do, but as corporations or banks who are running bond books, you have a lot of bonds of different maturities, different coupon rates, sometimes different optionalities. That means there's a need to measure and manage the bond portfolio risk. There are many risks associated with bonds, but the main ones are obviously default risk. Luckily, we could basket bonds into different default baskets, manage them separately. And managing a AAA bond portfolio is very different from managing a single B junk bond portfolio. But that's the default side. But more important risk is the interest rate risk. This is especially important if long-term bond portfolios are financed with relatively short-term loans. I will give you the biggest example of these from history, and we will also do another one from about 2 years ago. Do you guys remember Silicon Valley Bank? They were the hottest thing going in Silicon Valley. In fact, about a few months before they went down, I was part of a consulting project for them. A friend of mine was leading it, but he asked me to develop a overall interest rate risk management strategy because such big banks have to write reports to the Fed or whoever their regulator is. This is our risk management strategy. We're going to follow this. If Fed approves, fine. One of the first things I told them, there's a big mismatch between your assets, which were mostly long-term bonds. Remember, banks have to keep liquid assets, right? And they put it into 10-year, 20-year, 30-year bonds. But there was a problem with a lot of their deposits. 90% of their deposits were uninsured because they were lending to these either startup firms or venture capital firms, and venture capital firms were happy to keep their deposits in there. The trouble is, if it's over $250,000, FDIC does not insure that. And when there were rumors about losses with Silicon Valley Bank, there was a run on the bank. These people tried to get their money out because if Silicon Valley Bank goes down, their deposits are going to go unless FedRAMP stops them, which it did, but nobody knew for sure that was going to happen. And the only reason these guys went down wasn't because they were not profitable. They were a very profitable bank in terms of business, but they took a lot of long-term bond risk. And as interest rates were coming up, their bond portfolios started losing value, and people got panicked. They could not get new funding. They went just because of that. And we'll go through the details of that. So the first war story is from mid 1980s. This is before wide adoption of mortgage-backed securities. Do you guys know what a mortgage-backed security is? It's okay if you don't know. I mean, they are technically derivatives, but they're actually pools of risk. The simplest form is the so-called pass-through mortgage-backed security. Let's say I'm a bank. I find a client. These days, for example, Rocket Mortgage, the old Quicken Loans. Do you really think those guys place a lot of mortgages? They're very competitive. Do you really think that they actually finance all those mortgages? No. Here's what they do. They come to me or I come to them and I say, I'm going to buy a $400,000 house. Lend me 320, assuming I don't want to pay PMI, which is private mortgage insurance. They say, sure. They lend me the money. They have millions of other clients like me. Let's say on average, they lend $200,000 and 1 million clients. That's $200 billion, right? Even for a company like Rocket Mortgage, that's a lot of funding. When Silicon Valley Bank went down, their total assets were less than $200 billion. It's a big bank. So what they do, I mean, these days there are federal agencies that facilitate these. One of them is called Freddie Mac. The other is called Ginnie Mae. These guys say, okay, we'll come and buy those mortgages from you. Basically, they get a little spread. So Rocket Mortgage makes a little spread on the loan. Maybe they lend you at 3%, but they sell the mortgage to Fannie Mae at 295, and they make that 5 basis points over 30 years. That 5 basis points is a lot of money. Plus, they still get to keep the service, the mortgage, which means they charge all the fees and stuff. That is their business line. But in mid 1980s, these were, even though Freddie Mac and Ginnie Mae were in existence since mid 70s, mortgage-backed securities were not that common. One of the reasons was we had these institutions you may have heard of. They were called savings and loan institutions. Technically, they were banks, but you could not have checking accounts in there. You could have savings accounts, and most of their loan business were mortgages. In 70s and early 80s,